guys, welcome back to the Capital Mindset Show. Today, we're going to do things a little bit differently. We're going to do two different stocks in the same video. They're not really related to one another, but they are in some far off capacity, right? And I think it's important that we can learn a lesson from at least one of them. And then the other one we can actually look for and see whether or not it's an interesting investment or not. But the first company is Helion. Okay, so Helion was a subscriber request. And I think it's a good company to actually understand what a speculation looks like, right? And Helion Holdings Corp, right, is a company that basically is trying to eventually replace the way we do, trucking, right? They're trying to create these trucks. And we go on their website, for example, and we can see kind of like what the company advertises. And this is, for the most part, what they have, right? They're actually a pre-revenue business. And immediately, for me, that would always put that into highly speculative investments, right? So when something is before it's even, making its sales, I can't put money into that like a core position or even so much as a regular speculative position, because I do have speculative positions. And again, when I get to 1,000 subscribers, I will be releasing a spreadsheet for free for everyone to see. It'll be the portfolio updated once a month, and it'll show both core positions, semi-core positions, ancillary positions, and speculative positions, as well as a watch list. So, but for the most part, what we can see here is they got these different models that hopefully are going to be coming out soon. I think they are coming out soon, actually, but they're pre-revenue. So that already puts it into the speculative category, but highly speculative, not just regular speculative. And we can actually take a look at what the stock price has done. And remember, on this channel, we've been discussing for quite a bit the liquidity crunch that's occurred. The speculative assets are coming down harder than the non-speculative assets. And this actually was one of the, I think, the Wall Street bets, or it was pushed up during the era of Wall Street bets at its height. And it also was kind of, I guess, pushed up because of the SPAC craze. Because I'm pretty sure this one was a SPAC. Based on this price action over here, it definitely was a SPAC. And it had a high point of $50. Unfortunately, there are some people who bought at that price. So a lot of value destruction has occurred here, and it's already now about half of where it was during the SPAC, right? So no value has actually been achieved. And we have to ignore that PE because that's actually not real earnings, as we can kind of get into. But they have some transactions that make it so that they do have some earnings. So Google's picking that up, but it's not actually real cash flows or real earnings. They are, again, a pre-revenue business. And this is just an example of a highly speculative business. All right. Highly speculative, extremely highly speculative. So that's kind of going to be my thoughts on that. I can't really run it through the model because, again, there's really no numbers to go off of. And I would just be running around with it like a chicken with my head cut off, trying to make whatever projections I can. And also, this is, statistically speaking, within the 10-year time frame where businesses are very likely to go bankrupt, right? If you're those you may not know, the most probable time period for a business to fail is within those first 10 years. And if you wait after those first 10 years, statistically, you have a better shot at actually succeeding and thriving, right? So we would have to wait till 2025 if we were following just a statistical analysis or the rule of that rule of statistics, right? But that being said, that's not definitive or it's not a law. It's just, a good rule of thumb. All right, so let's actually go look at the other company, and you guys might have already seen it, and that's Honda Motor Companies. All right, so this one was also requested, and this one is related. I did say they were kind of related. They make vehicles, right? But a bunch of other things. So Honda Motor Companies is a large company. They do a lot of different things, right? So people might know them for their car brands or their motorcycle brands, but they do a lot of different other things like power equipment and other little machineries, right? Or engines for these machines. So very big business in Japan. We have a P ratio, according to Google, of 6.53. We'll take a look at that elsewhere. But for the most part, what we're looking at here, to not bury the lead, is a legacy Japanese car company, right? And one thing that has to do, or one thing that we have to think about with Japan is the domestic economy is growing very slowly. They have the other macroeconomic headwinds going on for them that we've discussed in other videos. But similar to what we've been discussing might occur in the United States is kind of happening ahead of time in Japan. They're a little further along that scenario. So that being said, when we look at Honda, we have to think about it from different aspects because they're not just cars. So if you just think about it from the terms of a car, which by the way, I actually like Honda's cars. Right now, the car I have is a Tesla, but I'm actually not opposed to Hondas at all. Actually, for me, I prefer not to spend too much on a car. That was a little bit of a once in a while thing, but Hondas, I do like Hondas. I like Toyotas as well. Actually, I think Toyota would be a good company to take a look at. But again, we've covered Tesla. We haven't covered Toyota, but we're covering Honda now. But we've covered Tesla in the past, and you guys might know my opinions on Tesla. All right, as a stock. Okay, so Honda Motor Company. Let's take a look at the price action. 5 years, it's gone nowhere. Okay, so that's not good, but that's drawing on the past. And over the max that Google offers, it's on only up 269%. So very poor performance. But again, you have to understand the macro backdrop where it is and all the competition. The car market is actually quite saturated. There's a lot of car companies. There's a lot of different opportunities for a consumer to buy a car, a lot of options, right? So let's go ahead and take a look at the model and see what the model kind of spits out for us. Let's first take a look at the key ratios. All right, so the key ratios, current ratio looks good. Cash ratio could be better, but it's a car company. Okay, mind that. And then the long-term debt ratio, very solid for a car company, actually. Total debt ratio, solid. Long-term debt to capital, good, it's improving. Okay, so the profit margins are declining. So you see the pandemic, the supply chain issues, profit margins or gross profit margins are coming down. Operating margins are going up. So they're improving the operations. However, it's down from 2017. Hopefully they can get that back up. Net profit margins are more or less the same. It's a little bit down from 2017 levels. ROA, ROE, it looks okay. For this kind of business, these are asset intensive businesses. That looks okay. So book value is going to be a little bit more important to me on the business like this. And so we look at book value per share. So it's trading below that book value. And then that's more or less tangible book value. But you can kind of see, I told you book value matters a little bit more here. The earnings quality is actually very poor for this business. I don't really like that. That's not a good thing for me. So that's a little bit of a markdown. So already there, Honda's losing points with me because it's consistently bad. All right. And then we see actually the stock consistently lagging in performance. So it actually makes sense to me. The numbers are telling me, hey, these are all consistent with the performance thus far. So, something to think about. All right, let's take a look at the cash conversion cycle. Okay. So supply chains are getting worse. Cash conversion cycle is telling me that right there. Days sales outstanding. Okay, so things are getting worse across the board. So this is screaming to me supply chain problems, supply chain problems, supply chain problems. Right. So all that is kind of makes sense, right? Because we know the context of the pandemic and then what's been going on. The companies themselves are telling us, hey, we're struggling with the supply chain. Okay, so now that being said, we know that this company trades on a PE basis, looks very cheap. On a cash flow basis, looks very different. Price to free cash flow, terrible. Actually, is expensive, right? So that's something actually to consider. Okay, now why is that, right? Well, if we kind of think about it, and this kind of gets into my mind, and again, this is raw. So what I think of when I think of a car business, right? We go to buy a car. Let's actually do it a little bit simpler. You and I, we go together to buy a car, and we stop at the Honda dealership. We pick out a car, and what are we going to do? All right. So are we going to pay cash? Right? Maybe not. Right? Maybe we have a loan. Maybe we don't have a loan. Let's say we don't have a loan. Let's say we go to the dealership. We don't have the cash, and we don't have a pre-existing loan from a bank. Okay, so we go without it. At the dealership, we may get a loan. Okay, oftentimes that loan can come from the financial arms of these businesses. Okay, if that were to be the case, right? If that happens, then Honda won't get its cash. All right, because what Honda will do is extend out a loan to us, and then Honda will make the sale. but Honda won't actually get the cash because its financial arm or the financial entity within the business will be the one lending out the loan, and it has a loan on its balance sheets, right? So then the cash will come later over time with interest. Okay. Now, that being said, if we switched it around and I come to the dealership and I have cash and I buy the car up front, the dealership makes its little fee, but the cash goes to the manufacturer, right? Where they make the sale. And I'm talking about just new cars. Okay. And so what if I go to the dealership with a loan from a bank, right? And this is how I've done it before. I have a loan with the bank. Then the bank pays for the car, and I owe the bank money. So that's another way to facilitate the same transaction. I think the majority of these transactions are occurring within the financial arms of Honda. That's my hunch. And I think that's what's causing the discrepancy between the recognized net income, because they're recognizing on the books a net income causing a PE to be very low, and it looks low. But the cash flows, the cash money coming into the business is much lower, right? Because they're probably extending that out utilizing loans. And that introduces an added risk of leverage. So the leverage of the macroeconomic backdrop, right? Because if something bad happens in the economy, then we have a problem, right? Honda has a problem. All these other car companies have a problem. What if there's a mass amount of people that can't pay it back? Let's think about the consumer base of Honda cars. Are they people who can tend to afford to pay out the car up front if anything happens, or are they sometimes the more vulnerable parts of the population? Maybe, maybe not. I don't know. It kind of depends, honestly, on what model of Honda we're talking about, right? And that's the thing. It's so nuanced. So the car business is difficult. Okay. I would say if you look at, for example, Mazda, these other smaller car companies, the ability for them to survive is kind of strained. And then you have the Goliaths like Toyota that's just super successful in that avenue, and they have their own thing. There's a book you guys should read. It's called The Toyota Way. I recommend that book if you guys are interested. No affiliate links or anything like that. Just go get the book and read it. It's a good book. So that kind of, in that book, they kind of explain Toyota's unique approach to business, right? And how all the other Japanese car companies are kind of, in a way, or all car companies in the world are kind of jealous of them. All right, so let's get it going on the model. So analysts say it's a strong buy, implying a 37.08 price target, which that's what implies a 27.3% upside from here. So that's strong buy rating. There you go. Just follow the analysts. Okay, so we're going to discount it at 10%. We're going to assume no buybacks. And by the way, Japanese companies don't really do that many buybacks. There are some that do, like Nintendo. I think Sony might. I don't remember off the top of my head, but they're also very conservative in their balance sheets, right? So Japanese companies tend to be. They tend to borrow less right now because they're in a long-term deleveraging cycle that's been going on since the 1980s. So again, humans live short lives, so sometimes it's hard for us to see the overarching cycles. But yeah, that's what's going on in Japan. So it kind of makes sense. But discounting it at 10%, we have to assume probably some really strong growth, which they haven't really done as far as cash flows go. And actually, let's take a look at the cash flows. So they're very lumpy, and actually that's very interesting. So at one point they got to the negatives right here in 2020. So they probably had to expense a lot of cash. So this lumpiness actually increases my uncertainty as to what my projections will be, or the accuracy of my projections. So I'm going to have a wide range, and then I already know I can't really be conservative, unfortunately. But let's go with a growth rate of 20%. And we can see at the 20% level, and then let's move this guy up here. So 2.75%. And let's put the middle one. Let's see if it's 15, because I'm trying to be a little bit aggressive here. So I'll put actually 15 here, and then let's put 12 there, and then 10 there. Okay, so based off of these projections, let's put an even weighting, because I don't know which one would be the one. All right. So if these are the projections, I think, and this is the range I believe, and I believe all of them are equally possible of happening. The model is telling me as like a flagpole estimation. And this is, again, I'm telling the model, hey, I want to make 10% required rate of return for the next 10 years. That's what I want, which implies a 159.37% upside. Okay, that's more or less in line. I mean, a little bit over what they've done in 10 years. Okay, in the past. So based off of that, and based off of all the risks, based off of the probability of bankruptcy, etc., the model is telling me, again, and I'll repeat this part, I'm weighting them all the same because I do not know which scenario is more probable. It is telling me that I can put about 0.54% of my portfolio into this investment. And that's what its opinion is. All right. We can disagree with the model or not. Okay. So I would say I wouldn't do that because I'm discounting it too low. I'm discounting it at the market level. Right. And I've expressed my opinion about this in the past that I don't really like to say, you know, the market average is 10%. There's some problems with that statement. But for the most part, you know, that's kind of like a good threshold that we have to surpass. And if I discount it, for example, at 12%, immediately the models tell me no. So when you see a negative number, I don't want you to think short. I just want you to think no. The model's saying, not worth it. Okay. If again, you say all those scenarios are equally as probable, maybe you think it's more probable that the 2.75% happens than the 10%. And then I would make the adjustment here and I would make those more probable. Right. And that's, again, we have to be a little bit broad with our estimations, and we want to cover as much ground as possible. But typically, I like to be more conservative. Okay, do I think that 20% is possible? It may be. Maybe they get back to this level of cash flows, but you know, how quickly would that happen? You know, what would happen? All right, so we can actually use this to give us an understanding or an idea of what growth rates we can imply. And this is the current, this is the max, so this is the recovery. This is the calculator that helps me figure this out. And we can see that if I wanted to grow at the average, I would have to imply about 5.8%. So it's still, yeah, it wouldn't be good enough. Okay. And that's assuming like average growth rates in the past. So that's not calculating like how to get exactly back to there. But anyways, so on that note, I think let me take a look at some of this. Yeah, it's fine. All right. On that note, guys, I think on this one, I like Honda as a business, but it's not for me as a stock. And I don't think I'm going to be putting it on my watch list anytime soon. But you know, I know of its existence and I'll keep an eye on it. All right, guys, I hope you guys have a good one. I hope this video helped. If this content does help you, go ahead and feel free to leave a like. If you guys have any questions, go ahead and comment down below. And I'll see you guys on the next one. Bye.